Think about a restaurant. The general managers and the waiters and the servers, they are extremely crucial in bringing an awesome experience to the people who are dining there. So similarly, the property management team.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is, the trinity of freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same. Welcome to the American Dream Builder and Investor podcast. This is episode 10, where we'll talk about how to vet sponsors. Today, we'll be sharing this episode with our special guest, Ben Nelson. Ben comes from an action sports background. He produced large outdoor action sports, a lot of races, very difficult things. And he has mastered project management skills through this type of experiences. He is also one of the 4 Iowa Oak Capital, where they have multiple properties. They specialize in Texas, Oklahoma, and Arkansas in the B-class value add space. We're excited to share this episode with Ben and talk about how both me and him look at evaluating and vetting the sponsors that we decide to work with. And just a little clarifications as well. Me and my company, Life Mission Capital, would typically work as co-sponsors, we're co-general partners, we're fund managers. What that means is we're a little bit more pickier on the investment opportunities compared to perhaps some of the other sponsors, because we work with a group of sponsors that's out there. And sometimes if they have found an opportunity that's working for them, we conduct another layer of due diligence. And some of the due diligence that we conduct is some of the things we're talking about in this episode. So I hope you enjoy. On the topic of evaluating sponsors, really we're trying to evaluate how likely it is for the sponsor to succeed on this opportunity that they're offering to you. We can always rely on past data. It is a very good indicator for future success, especially in areas like this that involves rinse and repeat, hopefully, that in that particular area, or their specific operational expertise. So the type of experience we're looking for is their specific experience on this asset class, whether that would be multifamily, short-term rentals, whether it would be mobile home parks, etc. Like each of those different asset classes has its own unique ways of operating and also growing that asset as well. And also understand their asset in a particular area. Like, for example, where I live and work, Northwest Arkansas, it's a very different market from Dallas, Texas. It's growing very fast, but it's a different market. And also their experience with the different unit sizes. For someone to jump from managing 5 single family to managing a 500 unit, that's a pretty big jump, not just in numbers, but the different unit sizes requires different operational expertise. And do they have the construction crew? Well, how about the property management company that I work with? Do they have the right operational expertise to succeed in implementing the business plan that we have? Do they have property management on site managing 500 units versus 10 single family homes? So those are all things to consider. And then there's more as well, all the questions to ask, because like, for example, I have an ebook on my website at lifemissioncapital.com that you can look at all the questions, but the goal is to give you a flavor of some of the things and really based on your conversation and intuition about that particular deal and what are the corresponding questions you can ask that solves your key questions and really significantly reducing the risks of your investment in that particular asset. Some of those metrics can also be a little bit qualitative, and I know Ben will cover a little bit more about it. But in terms of the sponsor's experience, it's also good to talk about how they overcome adversity. Everyone is good when they are getting what they want, but it becomes a problem when there's challenges in their way, when their interest is compromised. How do they act? Do they act in investors' best interest, even if it's not in theirs? Looking for stories of them, how they handle the recessions, whether it's 2008, 2009, or prior, or the small recession we had in COVID, or current recession that we're seeing right now in their acquisitions, anything that's happening different in their acquisition. Just trying to get a sense, not necessarily to really
get their answers, but just to see how they approach those questions. When we look at stocks, because a lot of you are probably familiar with the stock market, when we look at stocks, we not just look at how the company is doing, but also their leadership. So how is their current plan, their current vision for this year, for next year, for the next few years, and how do they handle investor relations? Do they just get your money and then just kind of don't talk about it for another 5-6 months? Or do they have monthly, quarterly reports? Don't be afraid to ask for samples, because you are putting your hard-earned money in there, whether that money is 10%, 1% of your overall net worth. You're investing for the long term. So don't be afraid to ask for some samples, understand the quality of the reporting. And it'll also help you understand what kind of sponsor are they? Are they more data-driven investors, or are they just more like, hey, everything's good, no worries, right? So kind of look for what kind of performance indicators are they tracking? Are they tracking leases? Are they tracking showings? Are they tracking conversion from all those activities and rent increases? What's happening in the neighborhood? What's happening in the specific submarket? How much transparency are they having on their next steps in that particular investment? Well, what's happening in their companies? Do they have any audits in their financials, especially if they're doing larger portfolios that involves maybe multiple assets together? Do they have audited financials? It's not instantly if they don't have audited financials, but it does give you more of a sense of comfort as well, especially if there are larger portfolios. On a single asset level, it's a little bit easier to follow. And how does their tax reporting take place? K-1 documents, for example, that's what you'll use for CPAs to file your tax returns. How does that look like? Do they come in on time? Even though it's always safer to file an extension, but you still want to understand what timelines they typically work with. So now I just cover a little bit more on the how do we watch out for clues of the likelihood of the sponsor success for your investment. We talked about experiences, the plan, and how they deal with investors on the investor relationship side. Now I'm going to pass it on to Ben, and for him talk about a little bit more on the qualitative metrics that you can look for.
This podcast is sponsored by Life Mission Capital, founded by me, Missy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom. Until one day, I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
Yeah, so I think you nailed it, Missy, and really your analytical brain is awesome at that. And that's something, especially with partnerships, I'll add a note, if you don't feel comfortable with some of these, please reach out to somebody that you trust, reach out to somebody in a network, even to Missy and myself to help explain or go through. There are people that have different ways that they think and operate, and that's why Missy and I are such a great team on this. My brain goes to the people, my brain goes to the process. And so the biggest thing is obviously evaluating the numbers and a lot of the things that Missy had mentioned, but also the people themselves, because the people are going to be actually operating this business, right? The business plan on paper is one thing, but really trying to get clues as to how they operate in real life. Getting a call with them, going through and asking some of these questions is going to be really important. So before we even get on a call, getting on their website, taking a look at their website. Is it professionally organized? Is it built well? Have they spent time thinking about their presence? Are they concerned with what their presence looks like in the world? A lot of that is just based around how much pride they take in their work. And are there spelling mistakes? Are there grammatical errors? Or things like that? Being really aware of how they operate and how they purport themselves. So this is the first line, right? Is if they can't create a sales document or if they can't create a website that speaks to you and speaks to you well, then there's probably some red flags in there. Across the website, is there a clear brand presence? Is there a color palette? Is the information readily available to find? Have you gone through and can you get to their investment portal from their website? Is a really big deal. Can you click through and is all the information for them being completely transparent, readily available for you to consume? And really you can kind of see, and I would say clicking around, seeing do they have goals? Do they have a value proposition? Do they have goals that are outside of just investing? Do they align with your morals and values? Do you care about that? Asking some of those questions, or even seeing if you can find that information before you have an in-depth conversation with some of these. As a part of that as well, and Missy kind of touched on it, really asking for some sample offering documents once you've had some of these conversations, or even talking through. A big practice of ours when we were getting into it, and something that we highly encourage our investors, is to give us a call. Well, you have access to these documents, you have access to sample documentation. If you have any questions, or even if you don't, let's walk you through it and we can give you some ideas of how we're thinking. So that's a PPM, a subscription agreement, our operating agreement if you're interested in for that deal, specifically sales materials, so pitch decks, webinars, one sheets. Every firm is a little bit different. Some people are super paper heavy in creating documents. Some are completely reliant on video presence and multimedia and uploading. Can you see some of their previous webinars that they've created? And just asking and getting a really good feel for who they are is incredibly important. So some of these we'll get into in a moment with due diligence as well, but just top line, it breaks down into some really simple questions about the market, about the property performance, about the loan, and about the deal structure overall. So with the market, just understanding, hey, why do you pick this market? Tell me a little bit about the market. Population, demographics, what are the submarkets? Where is this property that you're looking at? In what submarket is that located in? What's the competition? How many other apartment buildings of the same type are in the area? Are we expecting any type of natural disasters? Is it in a hurricane zone? Does it get a bunch of snow? Does it flood? That type of thing. And what are we seeing as far as rental rates in that market? And you can get down specifically from once you get to the market, you get down into the property overview. Please tell me a little bit about this specific property. How old is it? Has it been renovated? Have there been any CapEx projects that have gone on? Either have they been completed? Are there any planned? Can we see budgeting on that? Is there anything that you're concerned about? Condition of the property overall, like wiring, drainage, how old is the wiring? Has any of that been upgraded? Things like that are really, really important, all the way down to occupancy, transit, school system, things like that. So once you have the market, you have the property overview, then really dialing into the property performance and projections. Getting into the T3 and T12, which is a trailing 3-month and a trailing 12-month overview, and asking some questions and going through that. Occupancy rates. What are these documents? And what you're really trying to do is see, okay, this is the real actual performance of the property in the last 3 months or in the last 12 months. How does that compare to your projections? How does that compare to what you think you can do with this property as a sponsor? And digging into the reality of that, right? What is the expense projection? What is the expense ratio? What's the reality of what your expense ratio is compared to what it's been? What is the reality of your rent compared to what it's been? And just kind of asking, how do you get these numbers? Why do you believe that you can achieve these projections? And then once you have that, so property performance projections, getting down into loan information, asking them, how is the financing being sorted? Is this an assumable loan, which means you're taking that loan over from the previous owner? Is this a new loan? Is it multiple loans? Is it short-term? Is it long-term? Are you bridge debt into something else long-term that you're hoping for? Especially in this changing environment, these are really, really important questions to understand because of the volatility, but also just because that changes cash on cash. It changes a lot of things, potential capital calls later if you're not well capitalized, et cetera, just understanding what that is. And that kind of gets into a little bit more about the deal structure itself. Is there a preferred return? What are the splits? Is there a split above the first preferred return? Just really understanding why they've structured these deals. Each deal is different. Each sponsor is different. In different markets, there may be different metrics you're trying to hit. And as you as an investor, you may be able to try and be looking for something that's a little different as well. So is it a long-term hold? Is it a short-term hold? Is it all cash flow based? Is it an appreciation play? A lot of these are going to be very, very important. And I'll kick it back to Misi to understand a little bit more about that financial analysis and why digging into especially the deal property, the property performance is super important.
Yeah, thank you, Ben. Sometimes when you're working with a sponsor, they may or may not have an opportunity available to you right away. So this is where some of the things we're talking about is more digging into the sample offerings. If that's the way they're operating the last opportunity, there's probably a big similarity with how they're operating this next opportunity or next property. And essentially when it looks like your return as a passive investor, returns really comes in 3 areas: your cash flow, your appreciation when we sell or refinance, and your tax benefits. So understand how their approaches are to all of those from an income standpoint. What's their typical plan? Who are the partners they have in place within that region, with that market, to implement those plans with them? Do they have an in-house property management team, or do they hire it out? And how do they evaluate the property management company, right? Like the people who are hands on deck, think about a restaurant, the general managers and the waiters and servers, they are extremely crucial in bringing an awesome experience to the people who are dining there. So similarly, the property management team. So that's going to really affect your cash flow. That's going to really affect your expenses as well. Therefore, really affect your net operating income and subsequently your cash flow to you as an investor. And that net operating income is continually going to impact how your investment will be returned when we refinance or when we sell the property, because you'll probably learn a little bit about this a little bit later as well. The sell price or market value is really equal to net operating income divided by cap rate. Cap rate measures the risk and returns on this type of opportunity if we were just investing with cash. And then the net operating income is having positive correlation with your market value. So if you can make this property generating more net operating income, it's going to sell more. Simple words. So those are the key metrics we want to look at when we want to ask when we talk to the sponsor, maybe evaluating with them on the second call. Because sometimes on the first call, you're just trying to get to know each other, maybe having the feel of the sponsor. I recommend the second call and asking some of the more in-depth questions if those questions are not on their materials already. And understanding what's their exit strategies, like Ben mentioned, about financing is a long-term debt, short-term debt. That's going to affect your liquidity in the investment as well, how long you actually have the investment in the opportunity, as well as the likelihood of risk associated with the investment, whether it's variable or fixed rate in this market. And a few other things I'll touch home is essentially when you're looking at the opportunity, a lot of times you won't necessarily have access to the underlying underwriting. And there is a reason that most sponsors won't expose the underlying underwriting to you, is because it can get really confusing for people without understanding how the model works and etc. But you can ask some of those questions to see how they have dealt with those underwriting principles, because everyone's going to say, hey, it's conservative underwriting. Everyone can say a 30% IRR, internal rate of return, or 30% average annual return, right? Even though right now at the time of recording, we're seeing more between 15 to 20% average annual return being on the higher side, on the real estate side. But really understanding the assumptions that feed into those projections. This is where I like to talk about everything from a data side. For me, it's more like input, model, output. So the output is really the three type of return I mentioned. I mean, for the tax benefits, you can't do much about it. It's all like CPA, cost segregation firms work. But from a cash flow and also appreciation or refinance standpoint, that's where you have to look at what are the inputs that's affecting those outputs. So you can ask questions like, what are you factoring for vacancy assumptions when they're renovating their units? If they're doing really hardcore renovations, are they assuming 5%, 10% vacancies only? And depending on how strong is their crew, what's their historical track record in finishing the renovations within a short period of time, or 4 or 8 weeks, whatever that might be. Like, can they really renovate that fast? A lot of people have really aggressive vacancy assumptions during the first year, and that's common weakness that we see. And also expense ratios can really vary based on different markets as well, different asset classes as well. Like 30% to 40% is pretty common for mobile home park, but for a Class C apartment, maybe a little bit on the lower side, actually a lot lower. And for Class A, that could be different since they're a lot newer. One thing that you'll see that in terms of that's going to affect your investment a lot, that can be easily manipulated, is cap rate. To enter and exit, if you remember the equation I mentioned earlier, purchase price equals to net operating income divided by cap rate. Let's just say we did nothing to the property. Let's not worry about inflation, etc. Let's say net operating income is still $100,000, same as we bought it. But if your cap rate changed from 6% to 5%, I will be able to sell the property for 10 million difference. But will that happen? How likely is that going to happen? And there's many other aspects as well in terms of understanding how they really look at those assumptions. That's really going to determine, is it really conservative? I just gave you a few metrics here. And one common way to inflate internal rate of return is also when it's distributed. If for the same $100,000 that you're going to get back from your $100,000 initial investment example, if you receive that $100,000 daily, your IRR is going to look higher than if you receive that monthly versus quarterly versus yearly, even though most of the distributions out there tend to be quarterly just because of the process involved in the distributions. Sometimes you may not have cash flow a while, but then you have a large amount of returns via refinance or sell that can also make your IRR look really large because it's in a compressed time frame. But in fact, you're taking on a bigger risk when you don't get cash flow earlier. So all those are different factors to consider. The goal is to really understand the assumptions that goes into the model. So essentially, does it have a positive correlation with your returns, or does it have a negative correlation with your returns? understand how your returns are conservative or not on the scale. And that's going to help you generate a risk-adjusted model investment. At the end of the day, everyone want to be a billionaire. Do we want to take the risk of investing something that has a 0.0001% of winning, right? So understanding the risk for that return and make sure it fits your overall investment criteria. Now, that's a lot of numbers being thrown out there, and I had a little hard time calculating the simple math in my head. But now, Ben, back to you in terms of doing due diligence from a sponsor side. What are the other things you like to add before we close?
I mean, I think that that's the biggest thing, right? You keep touching on the fact that the numbers are there and they can be really cumbersome. And really, a lot of this, whether it be due diligence, whether it be the numbers, whether it be projections, whether it be calculations, whether it be IRR, cash on cash, asking the sponsor if they can have a simple call with you or have a Zoom and discuss how they're getting some of this, right? So a lot of this is due diligence. And I think the biggest theme here is, can the sponsor adequately describe to you the why behind the numbers or the why behind what they're doing, and understanding and make it translatable to you to where it's palatable for you to say, yep, this is something I'm interested in, or I understand what you're trying to do, right? So due diligence is a really big part of that as well, and understanding how they're getting to some of this and did they verify? Because it's one thing to say, well, we think we can renovate 30 units, or we think we only need to renovate 10 units. And the due diligence is the key to this, and making sure that they've actually asked the questions but followed up on the questions. So the due diligence process is fact finding. When they're evaluating this deal, say you found an apartment complex, it's 36 units. There's a classic fable that's out there of a sponsor finding a deal. Oh, this is an amazing spot. It's got 36 units, and he or she only walks 5, right? They get under contract, they make the purchase. All of a sudden, 10 of those units are not in the condition that the other ones that he saw, only 5 are. And so suddenly it creates a completely different scenario. And this person gets in underwater and they don't have enough cash reserves to renovate. The city starts coming down on them and all of a sudden they're in default. So it's incredibly important to ask some of these questions like, hey, have you or somebody on your team personally inspected every single unit? And it doesn't have to be an hour or 2 hours in every single unit, but it absolutely has to be that somebody has walked through every room, looked ceilings, floors, taken pictures. What condition is this in? And usually it's a grade. So what we do when we walk through these, we'll take pictures on every single thing, and we have about 10 different items that we say: fixtures, faucets, plumbing, floors, ceiling, tile, carpet, those kinds of things, and just rate them and say overall condition of this unit is a 1 through 5. And then how quickly are we going to need to renovate this unit on a 1 through 5? And we can build a process for that and say, okay, this is how we're going to be. So asking your sponsor, hey, what's your process for due diligence? Are you walking through? How are you coming up with these numbers? How are you realizing this business plan? And what does that look like? So in every deal, and I would ask very specifically, what is your due diligence contingency period, and how are you utilizing that? So in almost every deal, I shouldn't say every deal, but in almost every deal, there's some type of contingency period written in. So this is the fact-finding time. Being really efficient with that fact-finding time is important. Absolutely visiting the property obviously once, but also visiting the property at multiple times. What does it look like in the morning? What's it like in midday? What's it like at 10 at night when the lights are off, when nobody's there? Is there loud music? Is there a bunch of extra cars? What does the dumpster look like? Is it enclosed and is it clean, or is there trash spread everywhere? There's a lot of things that you can learn about the property, and they're not all necessarily bad things, right? Like value add operators like ourselves, sometimes some of these things can be a good thing. It's things that we can fix, but it's asking them, what have you seen personally, or what has your team seen, and how are you preparing for that? So the biggest thing here is making sure that there is a due diligence factor that is being taken very, very seriously, because that underlies how the property is going to perform and how all of the functions of all the calculations and all of the intended returns start with, this is our baseline, we know what we're getting into, these are our expectations based on that, and here's how we proceed.
Now, this is the end of the episode 10. I hope you enjoy the conversation I shared with Ben about how to vet sponsors. Even though we went into details on some of the other areas, such as vetting on the specific market and opportunities, essentially those questions are more guidelines for you to ask sponsors to see how they answer those questions and to learn about how they operate as well. So hopefully you have gotten the essence of this episode on how to
vet the sponsors from their answers. And so as a summary, in this episode, we talked about how to vet sponsors using data such as their track record, their experiences in whether the asset class, the areas, the unit size, the property management company, the general location and the adversity they went through, and also see their track record on the current plan. And another thing that's very important is also their investor relations experience, how they manage the communications and how transparent they are in their reporting. And another piece is really about just looking at the documents they have. Sometimes you don't always have an opportunity available to invest in right away. So look at how they have done those things in the past. Will give you great questions to ask about whether it's the market, about the properties, or the loan, or the deals. All those are really important, and that will help you understand how they're underwriting the opportunity from an income to expenses standpoint, and how they may be over or inflating some of the metrics in return as well. And last but not least, make sure you can also ask some questions around how they are completing their due diligence on the properties as well, from a physical to financial due diligence standpoint. So hopefully that helps.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.